There are three main types of banks: retail, that operate in the high street and work with individuals; commercial, those that focus on business customers; and investment banks. These help businesses work in the financial markets. Some banks work across these subsectors, but at any level, its income must exceed its liabilities to make a profit. Income is generated from the fees it charges for its services and the interest it earns. Its liabilities are its deposits or borrowings, which it uses to lend out or use to generate a rate of interest or fee income. While a bank's profitability is important, so too is its revenue. A big contributor to its revenue is net interest income. This is when earnings from its loans outstrips the costs of servicing its borrowings. But because loans are often based on long-term contracts and borrowings are shorter term, a big and sudden adverse move in interest rates can turn this around and bring about a loss. The lower the rate of interest set by the country's central bank, the more difficult it is for banks to make a profit. Credit risk. This is the risk of default on a debt that may arise from a borrower's failure to meet repayment obligations for whatever reason. Because banking is a highly leveraged business, to cover this credit risk, regulators dictate minimum capital levels to ensure that a bank remains solvent in the event of a bad debt. For example, if someone deposits £100 at their bank, the bank pays the lender interest, which is shown as a liability on the balance sheet. The bank then lends that same 100, say 10 times, creating £1,000 of loans to a number of people, each paying a rate of interest dictated by that person's ability to pay it back. The bank retains the original £100, which gives it a 10% capital ratio. Under current legislation, as a general rule, the bank must hold at least 10% in cash. Finally, the loan loss provision, or bad debt provision. This is an expense and represents the money set aside to cover loans the bank believes may not be repaid. Expect this number to rise when the economy is going through a tough period and borrowers, for whatever reason, choose not to or cannot pay back the loans. These are the main areas of interest for when a bank reports earnings.